welcome to the New Homes Horizon podcast by Nielsen Homes. I'm your host, Sara. Today, I'm joined by Joanie from Westpac Bank to talk about mortgages and financial tips. Thanks for joining us today, Joanie. It's really great to see you. I hear this is the first time for Westpac doing a video podcast.
Yes, definitely. So it's an experience, and it's good that I get to have the experience. Nervous, don't get me wrong, but yeah, it's definitely an experience. So yeah, very excited.
I think you've got some valuable information that I think first home buyers particularly can really use.
Cool, thank you.
So first of all, what is the process for a first home buyer when they're trying to look to get a house or a mortgage?
Sure. So I suppose the first thing for them to do is to reach out to a bank, or if they choose a broker, engage with them, get an application underway would be the best thing. So we would ask them questions such as their income, what is their income, what is their deposit. So for us at the bank, we'd pre-screen them first just to see, are they ready? If they're ready, we'll then move to an application with an appointment. If they're not quite ready, then at least give them some guidance of what they need to do to get ready, like increase your KiwiSaver contributions or save a bit more money, or basically cut down any debt if you've got a bit of debt. So once they're ready to do it, we basically arrange an appointment with them. So with the mobile mortgage managers with Westpac, so we can basically come to you at a time that suits, a place that suits, or you can meet us in a branch, or we can do virtual appointments through such things as Zoom or Teams, telephone appointments. So we're very flexible. So we basically come to you when it suits you and all those kind of things. So once we've ascertained and pre-screened you and everything looks good, it's then time to do an application. So the application process, I would say half an hour to an hour maximum. In the application process, we're going to be asking you things like, what's your income, what's your deposit, what are your expenses that you pay for, what are your debts that you have, and all those bits and pieces. You're then required to provide us evidence, so your bank statements, evidence of your expenses, your fixed expenses, like your insurances and so forth. We basically load all that information into the system for you and then generate a pre-approval, ascertain how much can you borrow. Generate a pre-approval, provide you with that magic piece of paper to say, okay, yes, we're going to give you a bank loan, or we can give you a bank loan based on these conditions. And then you're basically on your way to go and find your home.
So that finds out exactly how much they can go and look for.
Exactly how much you can go and look for, yep, 100%. Yes. So that is basically the figure, and that will give you an indication as to what your purchase price can be based on your deposit as well.
So when you're going to this kind of pre-approval screening, what documents would you need to prepare?
Sure. So we always ask for your last 3 months bank statements, so your full bank statements of any transactional bank accounts that you use, any credit cards that you may have. So that's to verify your income and your expenses. We also can ask for savings statements if you want to see what your savings history is. We ask for statements or evidence of any debts that you've got, just to make sure that you have solid repayments on those debts, you're not missing them. Insurance documents, we need to verify that your insurance premiums are exactly what they are, especially if we can't see them clearly through your bank statement. So there are some documents we may not need if the transaction is evident to us in your bank statement, so we can clearly see it. The most obvious one, of course, ID. Those would be the standard documents, I'd say. It's case-by-case basis. It depends on people's circumstances and what they may have. There may be additional information that we need to get from them. If they're self-employed, it'll be business financials or potentially tax summaries. If they have certain things from overseas that we're going to be using within our application, we may need to get documentation from overseas. So if they have some form of income from overseas, or they're collecting rent from rental properties overseas. But yeah, the standard will be those first few things that I said, the bank statements, credit card statements, and ID.
Right.
Yeah.
So the meeting that you talked about takes about half an hour. How long does the actual approval process take till you get that pre-approval letter?
Sure. So half an hour, I suppose, to capture all information. Sometimes a meeting can take a bit longer. It could be about an hour with the questions and everything else, and doing all sorts of other bits and pieces that you may have. The pre-approval stage, so we can approve a loan for you within 24 hours.
Oh wow.
So when you're going directly through the bank, or through, I should say a mobile mortgage manager or mortgage specialist like myself in a role that I do, we can approve loans under our own authority. Majority of loans we can approve under our own authority.
Okay.
So if it is a clear-cut loan, there is no exceptions that are required, or there is nothing that we need to actually get signed off by our credit team, within 24 hours you could have your pre-approval. If there is one of those other factors like an exception, or there is something that we couldn't approve under our own authority, we then send it to our credit team. So they can take a maximum of 3 days, but in most cases it's 1 to 2 day turnaround. So it's a pretty quick turnaround.
Yeah, it is.
Yeah. And we all like to get it done as soon as possible.
Yeah. So what different types of mortgages are available to first home buyers? I know there's things like if you've got not as much deposit, and how does that kind of affect the mortgage process?
So there is the standard mortgage. There's a standard mortgage to buy an owner-occupied property where you require a 20% deposit. That's the standard. To buy an investment property, you need to have a 35% deposit. But I'll talk about first home buyers instead of investments. So the standard is 20% deposit. However, there are some other different schemes that can assist. So there is a scheme called the Kāinga Ora First Home Loan. So you could have a deposit as low as 5% with that particular scheme, 5% of the purchase price of the home. And basically Kāinga Ora comes in behind the bank and assists us to secure that particular home loan for customers. We can look at present, and obviously subject to change, things are always changing, we can look at as low as 10% deposit for new builds. That is for new builds only at the moment. So those are probably about the only options that we have at this point of time, hoping to get a few more if we can. And things are always changing constantly. But those would be the main ones. There is also Springboard, sorry, I forgot to mention that one. There is Springboard loans, where basically if your parents own a home, you can basically springboard off the equity within their home. Okay. So we can set that up for you. It does mean that we're taking security of the parents' home as well, and there is a mortgage portion against that home, so it's called a springboard.
If you were to do, for example, the 10% deposit instead of the standard 20%, would that mean that the interest rates change, or are you paying kind of more of a premium on the interest rate, or how does that work?
You are. So for the first home loan, where you can get a 5% deposit, there is no, and that's supported through Kāinga Ora, there is no markup on the interest rate on that particular one, because there is a fee that is added onto the loan for that. So the interest rate does not increase. For the 10% deposit one, like for a new build, there is a margin added onto the interest rate for that. So whatever the special, the base interest rate or the special rate is, there is a margin added onto that. And that could be between 0.25 to 0.75, depending how high above the 80% mark you are.
If I was just starting my journey and I hadn't talked to a bank or a mortgage broker yet, but I just wanted to get a rough idea of how much I could buy a house for, is there an easy way to figure that out?
Yeah, definitely. So on the Westpac website, under our products, and then under the home loan component, there is a whole lot of calculators there. So there's multiple calculators there. There's a calculator that you can plug in different bits of information, income, expenses and that, and it will give you a rough indication of affordability. There is also a calculator on there if you're wanting to look at, okay, if I was to have a home loan of 800,000, how much is this going to cost me based on the current rates? So the affordability calculator, and to see how much you can borrow and so forth, they are all very indicative. So it's not necessarily what you will definitely get, but it gives a very good indication. Yeah, definitely.
So other than your income and your standard expenses, what other factors are taken into account when looking to borrow?
So apart from the income and standard expenses, debt. your debt would be one of the biggest things.
And how would that impact on how much you can borrow?
So I suppose it depends on what your debt level is really. So if you have a high debt level, like maybe big car loans or something of that particular nature, it can reduce down your borrowings. If you have high limits on credit cards, that also can reduce down your borrowings. Because of course when we're assessing your application, we're looking at what your repayments are. For credit cards, we take 3% of the limit. So we have a lot of clients who are like, yes, I've got a $20,000 credit card, but I pay it off every single month, or I've got a $20,000 credit card and I never ever use it. But we calculate on what the limit is, knowing that we have no control after we've done your application if tomorrow you go and bang a $20,000 holiday on it. So it calculates the limit. So when we're doing an application, in some cases, if a customer is a bit short for what they require or what they would like, then we ask them if there is an option to reduce down debt, reduce down your credit card limits if you can. Can you pay maybe a chunk on your personal loan or something of that particular nature and then restructure it to reduce down those payments.
What does the pre-approval for your mortgage actually mean? What does that entitle you to kind of do?
So a pre-approval letter is going to have conditions on it. So there's going to be certain conditions. One condition is always going to be a sale and purchase agreement, which is obviously being signed by the vendor and signed by yourself and agreed to. There's always going to be that particular condition. There may be other conditions on there as well that need to be met. For example, the reduction of a credit card or confirmation of a certain expense or confirmation of income. There could be a whole rife of different conditions. So basically, a pre-approval is telling you how much the bank can lend to you, but there are conditions against it. Once you meet all those conditions, then it becomes what we call an unconditional offer. So that then more or less is, I suppose, a guarantee for you that yes, we will support you with this purchase. So you've met all the conditions that we want to be able to give you the money. So at the point in time that you require it, we will come up with it and give it to you to make the purchase.
Looking for a home is not a quick process. Sometimes it can take quite a while. So How long does this pre-approval last?
Sure. So with Westpac, your first pre-approval is valid for 90 days. If you've got a 10% deposit though, it is valid for 60 days. However, after be it the 60 or the 90 days, whichever pre-approval you've got, basically we can then roll it over for another 60 or 90 days. We check with you that there hasn't been any change in income or circumstances or expenses or anything of that nature, and we can then renew it again. After that total 180 days, we then need to basically reassess you fully again.
So what happens within those 90 days if things like the interest rates go up or there's something quite significant that happens that would not necessarily change your circumstances, but maybe your ability to repay a higher interest rate?
Sure. So the banks, when they calculate a loan, they always have an interest rate in the background that they're using to safeguard that. So basically, how can I put it? You're safeguarded from that basically happening. So they'll always make sure that what they're calculating in the background or how they're assessing your application, they're not going to put you in a position that we're going to approve you now for 500,000 and our system is calculating it on, let's say 5% is just a rough figure. However, you've found a home now and the interest rate's at 7%. So yeah, there is systems put in place to basically protect someone, so we know that what they are borrowing is something that they will be able to afford if the interest rates at that point in time that they're due to put in interest rates are higher.
What are some common misconceptions about mortgages that first-time buyers have when they come in?
I suppose one of the misconceptions that I have is we have people coming to us and saying, I really want to buy a home, but I just don't think I'm ready at the moment. And it's like, well, let's sit down and have a conversation to see if you are. And the amount of people that I've managed into their first homes who came to me and said, I don't think I'm quite ready at the moment, but you crunch some numbers, you have a look at bits and pieces, and they are ready. So I suppose the misconception is I haven't actually got quite enough deposit, or they don't know about the different products that we can offer at Westpac, like for example, the first home loan where you can have a lower deposit. Sometimes the misconception is that, oh, you must have a 20% deposit, basically. So I would say that would probably be the biggest one, that people lack a bit of confidence, thinking that, you know, it's a dream of theirs, but they think they can't achieve it, but they still just want to have that conversation to see what can they do to get on the right track. So I've had many clients like that, and yeah, we've got them into their first home, so it's really rewarding.
So your advice would be, even if you don't think you're ready, just to go and have a chat to see?
Oh, definitely, because if you're not ready at this point of time, we're going to put you on track to give you ideas as to how you can make yourself ready. And we do that with many, many clients. And then, you know, you hear back from them in 6 months or a year's time, and it's sort of like, okay, I'm ready now, I've managed to save this amount. It's giving them some guidance and telling them what they need to do, because they may not know what they actually need to focus on to achieve that. But yeah, I've had many clients who a year ago had that conversation with them, have come back now. There's just been so many of them, and you've given them that guidance. They've taken it and gone away, you know, put it into play.
What role does credit history play in the mortgage process?
So credit history plays a big role, basically. So whenever we do an application, we always ask your permission if we can run a credit check, because it's always going to be done. Once your credit check comes up, we're basically having a look to see if there's any adverse features. Have you missed any payments on certain accounts or whatever? We will always come back to you and ask you for an explanation for it. So it's not just you've missed some payments on a particular loan that you have, or a credit card. It's not an automatic decline. We come back to you and we want to get an understanding. So we're trying to get people into homes and not just look at one adverse effect and say no. So we'll basically ask you, what's the history about this? What has happened here? We then can see, is it something that we can mitigate, or is it something that someone may need to work on? For example, I'll just give you a quick example. If there has been a poor repayment history on something that has gone on for, let's say, 6 to 12 months, we may say to you, okay, how about you have a clean repayment history for the next 6 months, then come back to us, and then we can have a look at this application. Defaults, if there are defaults that have not been paid, that could have an effect on an approval. Again, we'd find out, why hasn't it been paid at this point of time? What is it for? How did it come about? If there are defaults that have been paid, then it's not necessarily an adverse feature. Again, everything is mitigated on the credit check, basically. We also look at the number of inquiries that you have on your credit check as well. So if we can see that you've got a lot of inquiries and constantly seeking debt of some sort, then we do question you about that. But it could be an adverse feature if there are a lot of inquiries.
Mm-hmm.
So, but yeah, we work with you as much as we can on credit check. So a credit check may show something that's not too favourable, but we'll always come back and find out the answers why.
What's the difference between going straight to a bank and a mortgage broker?
Sure. So I suppose there are a couple of differences. Both going directly to a bank, or I say a mobile mortgage manager or mortgage specialist like myself, or a broker, all of us are wanting to get clients into their first home. We're all passionate about what we do and about home lending. The difference between someone like myself and my particular role in a mortgage broker, I would say, is, as mentioned earlier, I do have the ability to approve a lot of loans under my own authority. So it could be a quick turnaround within 24 hours that I can get that loan approved for you. Going directly through the bank, that means that we have knowledge about the products that we're selling to you, the different types of home loans and all those bits and pieces, so we know I suppose, have more in-depth knowledge about the products that we have. There is a bit of a misconception that a broker can get you better interest rates or potentially better cash back. But this is a misconception because we're under price parity. So basically we all get the same. We all go to the same, well, sorry, if there was a broker doing a loan through Westpac and me doing a loan myself through the bank, since I work directly for them, we'd still be getting the same price. But yeah, across the whole board of everything, there is price parity. So yeah, I suppose it would come down, all of us are passionate about home lending, be it a broker or the bank, but it would come down to product knowledge, I suppose the speed of when you can get a pre-approval done. For the mobile mortgage managers, like my role, so we're also there for our clients after they've purchased their home. We basically invite customers to make contact with us again if there is anything else that they do need. It could be in another field of banking, and be a point of contact for them as well. So yeah, that's I suppose an extra added thing through the bank.
So when someone comes to buy a home of us, we require a 10% deposit. Can you explain how this 10% deposit is different to the bank deposit?
Yep, sure. So the 10% deposit that you're asking for is obviously to secure the buyer or to commit to the purchase of that particular home, so you can therefore take it off the market or mark it as sold. I'll give you an example for this, and I'm going to base it off a 20% deposit and an 80% bank loan to give you that full 100% purchase price. So let's say that the price of the home is $1 million. We'll need a 20% deposit, which is going to be $200,000, and then you'll have a bank loan of $800,000 to make up that $1 million. So therefore, Sarah, you would be asking that client or that purchaser for 10% of that $1 million, so they're going to pay you $100,000. They then, to complete the purchase, require to have another $100,000 of their own funds, because the bank is only going to give them $800,000. So therefore they require the other $100,000, which they would then pay at the end of the transaction once you go into settlement. So all the deposit side of things goes through your solicitor basically. Obviously when you're making that down payment, when you've made an offer, that portion will go to the developer or the real estate agent. The remaining portion that is required all goes through your solicitor. So that's the difference. And yes, it does get quite confusing for some customers, definitely, because you're talking about deposits and you're talking about two different percentages there. But hopefully that explains it best. But we would sit down and write it out for a customer if they were still a little bit confused.
How much does the amount of the deposit affect how much you can borrow?
Sure. So in the bank, we look at things in two folds. We look at what is the deposit that you've got, and with your deposit, what is the maximum purchase price you could get with that deposit. We then look at what is your income and what can you service or what can you afford in a loan. So I'll give you an example. Let's talk about the $1 million house again. So you've got a deposit of $200,000. That $200,000 as a 20% deposit means you can buy a home valued at $1 million. However, you're on an income of, let's say, $50,000 annually. And we do a calculation for you and we realise that with an income of only $50,000, you could only afford a home loan of, let's say, $500,000. But you actually required a home loan of $800,000 because your deposit was going to get you a purchase price of $1 million. You needed a loan of $800,000, but your income, unfortunately, is not going to be able to support a loan for that high. So that's why we look at it in two folds. But the biggest factor at the end of the day is how much can you afford in a loan.
So what government programs or incentives are there at the moment? I know there's change constantly, but just right now, what can you offer first home buyers?
Sure. So there is a couple of products through Kāinga Order. So Westpac is one of the banks that does what we call a Kāinga Order first home loan. So that's where customers could have a deposit as low as 5% to help them get into their first home. So under that particular product, there is an income cap. So a customer must not earn more than 150,000. Joint income mustn't be more than 150,000. Single income must be no more than 95,000. A customer cannot have more than $10,000 unsecured debt for that particular loan, and then again 5% of the purchase price for that particular scheme. The second one is the Kāinga Order First Home Grant. So that is when you can apply for a grant through Kāinga Order. You can get up to $5,000 for a really established home, or you can get up to $10,000 for a new built home, and that will go on to your deposit. So the grant, you need to apply through Kāinga Order for that to be approved and accepted. And there are certain caps as well for those particular grants, but all that information is on their website, so we direct customers to that. We don't get involved in that side of things. The first home loan side of things, yes, you come to the bank and we basically work on the application for you with that, and the bank communicates with Kāinga Order in relation to that particular product.
And what about KiwiSaver?
KiwiSaver, yep, definitely you can use your KiwiSaver. So that is obviously a government fund, and a lot of people use their KiwiSaver. You need to be contributing to the scheme for a minimum of 3 years before you can actually access your funds from KiwiSaver.
Okay.
Yeah.
And finally, do you have any words of advice for any first home buyers looking to start their journey?
Any advice? I would say, yeah, definitely just take the plunge, make contact with someone, speak about your options. If you've got that itch and you think that you really want to buy, or this is the time of your life that you're wanting to look at this, be it you're wanting to go out and buy or you're wanting to get on the track, then just reach out and ask for an appointment, ask to get the guidance. We'll soon tell you if you're ready or not, or otherwise we'll get you on the right track. Yeah.
Great. Thanks for joining us today, Joanie.
That's all right. Thank you so much for having me.
Great.
Thank you.